In the 1630s, the Dutch Republic is in the middle of its golden age. A booming global trade network is pouring money into the nation, creating a society of merchants flush with surplus cash and looking for places to spend it. The ultimate status symbol for all that new wealth was a flower, specifically the Semper Augustus tulip. Its striking, flame-like red and white petals were actually caused by a mosaic virus, making it both stunning to look at and incredibly difficult to reproduce. Because it was so rare, the price steadily climbed. By the winter of 1637, the cost of a single Semper Augustus bulb hit a staggering 10,000 guilders. To put that in perspective, 10,000 guilders was enough to buy a grand luxury home on the nicest canal in Amsterdam. People were trading the cost of premium real estate for a single flower bulb that fits in the palm of your hand. How did a society of calculating merchants fall into such a frenzy over a garden plant? And when the market finally broke, did it actually destroy the Dutch economy? Or is the great financial apocalypse of 1637 a 400-year-old myth? To understand the madness, you have to look at the psychological environment of the mid-1630s. A severe outbreak of the bubonic plague was sweeping through the country. With death a constant presence, a fatalistic mindset took hold among the working class. If tomorrow wasn't guaranteed, taking extreme financial risks today suddenly seemed entirely logical. That appetite for risk collided with a brand new financial invention, a legal contract the Dutch called the ace. Today, we call it a futures contract. The ace let traders buy and sell rights to tulip bulbs still buried in the ground. Because you were trading paper promises, you didn't need the full purchase price up front. You only needed a fraction of the cost, borrowing the rest on margin. This mechanism threw the market wide open. You no longer needed to be a wealthy noble or even know how to grow a flower. Everyday artisans, weavers, and bakers started buying aces and quickly flipping them to the next buyer for a profit. In just a few years, the Dutch tulip trade mutated from a localized market for physical luxury goods into a highly leveraged, chaotic casino built entirely on paper promises. By the winter of 1636, the action had moved out of formal merchant exchanges and into rowdy, smoke-filled taverns. Traders were no longer valuing the tulips themselves. They were operating on what economists call the greater fool theory. It doesn't matter if an asset is intrinsically worthless, as long as you believe you can sell it tomorrow to someone even more foolish than you. This chart tracks bulb prices. Look at the blue and yellow lines for the Semper Augustus and Gouda varieties. Leading into 1637, prices spikes vertically. Look at the far right edge. On February 3rd at a Haarlem auction, that upward trajectory hit a wall. A seller offered a batch of bulbs at a standard asking price, and no one bid. He dropped the price a little lower, still nothing. He cut the price a third time, and the room remained totally silent. In that silence, the illusion broke. Everyone realized simultaneously that there were no greater fools left to buy their contracts. The panic spread from tavern to tavern, and within days, the entire tulip market lost up to 99% of its value. Paper wealth evaporated overnight. According to popular history, this sudden vaporization ruined thousands of citizens and plunged the Dutch Republic into a devastating economic depression. For centuries, the standard historical account, popularized by a Victorian writer named Charles Mackay, claimed that the crash swept away massive fortunes, caused widespread bankruptcies, and delivered a severe shock to Dutch commerce. Modern archival research tells a completely different story. When historian Anne Goldgar dug into 17th century court and financial records, she found that Mackay's terrifying narrative is mostly fiction. The Dutch economy was incredibly resilient and continued to grow. Goldgar found almost no record of anyone going bankrupt solely from trading tulips. Because the network of buyers and sellers was relatively small and isolated from the broader economy, the systemic financial impact was practically zero. So why do we all know the story of the crash? Because conservative Dutch elites and Calvinist pamphleteers invented the apocalypse. They were deeply anxious about the rise of social mobility and the radical new idea of making money purely through financial trading rather than physical labor. They exaggerated the fallout in pamphlets and songs, creating a moral fable to punish greedy speculators. The historical record shows no macroeconomic tragedy. The apocalypse we remember today was actually a cultural and moral panic over the unfamiliar, terrifying new realities of modern capitalism. While the Dutch Republic survived, the psychological behaviors they documented during the mania did not disappear. The financial instruments have evolved, but the human drivers of FOMO, herd mentality, and greed are exactly the same today as they were 4 centuries ago. It is easy to look back at the 1630s and laugh at people trading houses for flower bulbs, but we see the exact same speculative frenzies in the dot-com bubble and modern cryptocurrencies, where traders buy digital code hoping to flip it. The Dutch experience laid bare a core law of markets. Whenever the price of an asset detaches entirely from its intrinsic value and relies solely on hype and borrowed money, a crash becomes mathematically inevitable. Whether you are trading a virus-infected flower or a volatile string of blockchain data, the ultimate danger in investing is forgetting the fundamentals. Because when the music finally stops, you do not want to be the last greater fool left holding the bag.